Welcome back. We've been in conversation with Christopher Wood, the Global Head of Equity Strategy at Jeffries. Of course, an undisputed veteran. Chris, you were telling Nigel that more and more investors are asking about an ex-China EM basket. Have people already started investing on those lines, or do you see a major shift, new indexes being adopted?
No, people had started to do this, but actually this is a bit ironic. Originally, about 3 years ago, this idea was kicked off because China was such a big part of the benchmark that people and the A shares were going to get included more and more, the mainland market, that the view was that it's better to have your China dedicated mandate because otherwise it would dominate the benchmark and the rest of the emerging markets should be treated separately. So that was the origins of this idea, but in the last 2 years, it's actually morphed into the fact that more and more people are viewing China as uninvestable, or, particularly in the case of the US, there's obviously growing political pressure for some quarters not to invest in China at all for geopolitical reasons. So for both reasons, this trend is growing. But I've been advising fund managers who have emerging market businesses, they should definitely come up with, they haven't done it already, and some have, with a product offering ex-China, because there's going to be growing demand.
Fair point.
And clearly, all this means that India's benchmark weighting would be higher in such a portfolio, or such a benchmark.
Right. Chris, I wanted to ask you about a couple of other asset classes besides equity as well. Emerging markets like us, we track, the dollar index closely as well. It went to around 115 but cooled off from there. What's your sense on that front? And crude is a big factor here. It's getting uncomfortable towards that $100 per barrel. Outlook on that as well?
Well, yeah, I remain very bullish on oil. I think oil goes materially higher. My favorite sector in global equities is energy. So in a global portfolio, I want to have weightings to India for obvious reasons, but I also want to hedge that with energy exposure, because clearly energy is a vulnerability for India. Though I think India is less vulnerable to rising oil prices than 10 years ago. But the irony is that President Xi, while he's not doing the Chinese economy or property market any favors with his very strict COVID suppression policy, he's done the rest of the world, including India, a big favor, because the one area where we have tangible evidence of demand destruction for oil and energy in the global economy today is China. So the oil price would be materially higher today if China was not implementing COVID suppression.
You want to give us a level on where you see crude headed, or the dollar index as well?
Well, no, the dollar rally's in its final stages here because I believe the Fed is going to fudge its 2% target. But the oil. Now, obviously, I'm saying the US can go into a recession next year. In Europe, that's got to be the base case with the aggressive monetary tightening. That should be very negative for oil because it hits demand. So that is the risk to oil. But fundamentally, I think this oil cycle is different from all previous ones, because I believe the key positive for oil prices isn't demand, it's supply constraint. And we've had a dramatic lack of investment in energy oil in the last 5 years and more because of the political attack on fossil fuels in the Western world, which has disincentivized the oil and gas industry from investing. And you just saw Exxon, Chevron, I believe, report record profits last year. They're cutting their investment because there's all these political signals that they shouldn't be investing. And what they're doing is they're paying out more cash flow to shareholders, and they're making some token investments in the renewable space to kind of appease the political pressures for them to be doing more on renewables. But from a shareholder standpoint, they're paying out cash flow. There's a lack of investment, and that leads to upward pressure on the oil price. So the irony is that the attack on fossil fuels of recent years creates the potential for a dramatic spike in the oil price to new all-time highs.
Okay, that's not a very happy combo if the world, a large number of developed markets are heading into recession, but crude still remains strong. Not a good combo for India. But, the positive appears to be that in the BRICS combined, Brazil has gone leftist. Russia is uninvestable. China, you're saying, is looking very difficult to find investment options given the slowdown. South Africa is not the best of places. So do you see more money coming into India? Are you looking at some levels that you can share with us for the Nifty or for any of the major stocks?
Well, on India, what's been amazing about India this year as a stock market is its phenomenal resilience in the face of a very weak Wall Street, in the face of record foreign selling of Indian equities in the first 6 months of the year, and in the face of a quite significant monetary tightening cycle by the Reserve Bank of India. So I think I checked the numbers today. India's down, the Sensex is down about 6% in US dollar terms. The S&P is down 18%. The Nasdaq's down 29%. So India's been phenomenally resilient. And what's happened from a fund flow standpoint is the foreigners, having sold India in the first 6 months of this year, have started to buy it back again last quarter. I understand why foreigners were selling India, because it was at peak valuations and they were putting money into China late last year. I would have done exactly the same thing because China had started to ease fourth quarter last year when the rest of the world, most of the rest of the world began to think about tightening following the Fed signal. So people went into China, but clearly the move into China was undone by COVID suppression. So right now, I'm fundamentally staying overweight India. I wish I'd been more overweight than I was. The reason I wasn't more overweight was because of my concerns about monetary tightening in India. Fundamentally, India is the opposite of China today. In China, we're looking at the biggest downturn in the residential property market in China since it was privatized in 1994. That's the most important sector in the economy. In India, we're now in the second year of a residential property upturn after a 7-year downturn. That creates very positive multiplier consequences for the domestic Indian economy. We see credit growth rising, and we see growing evidence that Indian corporates with healthy balance sheets are increasingly thinking about investing. So to me, India is very well set up. And the resilience of the market this year, the Indian stock market, in the face of a very bearish global environment, tells you how good how well positioned India is domestically.
Okay, all right. Chris, let's get a little bit into that then. What are the changes you've made to your India portfolio? I recall the last time we chatted, I think Tata Steel made its way out. So you were a little bit jittery on that space. But the real estate basket, Macrotech made an entry. You lightened some positioning, I think, in Godrej properties, if I remember correctly. What's the recent changes you've made?
I've hardly changed anything. My portfolio is very much set up structurally for the domestic demand story in India, based on banks, property, insurance. If I had to sum it up, with one or two, with a bit of exposure to capex. And in my Indian dedicated portfolio, I have energy plays to hedge the obvious oil risk.
Okay. You're not getting any of the IT companies back in?
No, but that's not because I'm particularly negative on this. It's not my, it's not, because this is predominantly playing around the domestic demand theme. So I was expecting my portfolio to go down a bit this year because it's an interest rate sensitive, in fact, more than a bit, because of the monetary tightening cycle. But what's been remarkable is how resilient the market has been in the face of this monetary tightening.
So, Chris, just a final, trader question. Does Nifty go to all-time highs in 22 itself? I mean, we're not a long way away from 18,600. And is 20,000 a reasonable expectation in 2024?
Well, I think the key thing is the market, I think the Indian stock market can go materially higher in the next 5 years, assuming we remain in a residential property market upturn, and we get a capex cycle following it. And I think the other point, which is less related to the stock market, but I think is very significant for the Indian economy, is all these issues in China increase the likelihood that there will be a significant increase in foreign direct investment in India in the manufacturing area.
Yep, we are seeing signs of that. Thank you very much, Chris Wood. It's great to end this interview on a very strong note, an optimistic note for our Indian viewers. Thank you very much for joining us in
Thank
this
you.
special edition of Market Masters.